Right, how we doing? ACCO Brands today, ACCO. Yet again, another one that looks like dog shit, hence why it's turned up on my screener. Um, let's just get straight into it, to be honest. I didn't do too much on this one, to be honest, before I said no. So if you're going to come and try and hear like a positive thesis, it's not something that I want to invest in. Not yet, anyway. But I will give you my reasons why. Hang on a minute, I haven't even got it open on a. Just get it open on a spreadsheet. I ain't got my spreadsheet up. Here we go. Now we're cooking. Yeah, ACCO. Looks like dog shit. Is it dog shit? We'll find out. Like I said, I'm not willing to invest in it currently. But I will give you my reasons for why. Market cap around about 300 million. Enterprise value 1.18 billion. Straight away, you can see that there's a lot of debt in this company. About 8.1% of it's owned by the insiders, so you know it's not too bad. There's definitely worse out there than that. I would like to see a bit higher, but there's some sort of investment from the insiders into this company. You know, or if the company goes wrong, there's not really any funds though that are holding it. If we look at institutional investors, whatever, 3.7% of the portfolio, everybody else is like not even remotely bothered in this company. Who is the highest ownership? So there is a company with got 8% and another company of 8%, but look at this. But there's a portion of their BlackRock, obviously, it's going to be nothing, but this one here, there's a portion of their portfolio. They're not interested, are they? To be honest, it's not going to make a material difference to them. Therefore, I don't like any of that. I want to see people that are invested, and they are not. And the insiders, the insider purchasing, that's not worth nothing. It means nothing to me. Something that low, there's no conviction in that. That's just like, it's like a token thing. Let's just show that there is something going on here. I'm the CEO. Let's do it. But come on, 20 grand. Nah, it's not good, is it? Not good insider purchasing. There's no conviction in a purchase like that, not for me. So we'll drag it up here. We'll drag up my notes and we'll see what we're talking about. So for those of you who don't know, ACCO Brands designs, manufactures, markets consumables, consumer school technology and office products. So calendars, planners, dry eraser boards, notebooks, janitorial supplies, storage, organization products, lever arch binders, sheet protectors, indexes, laminating, binding, shredding machines, all sorts of stuff really. All sorts of stuff that is easily replicated by places like China and India. You know, so difficult place for this business to exist in, especially with, you know, emerging economies and all that sort of thing, doing exactly the same sort of products. So yeah, not great. Future risks: weak demand for traditional office products, shifted digital tools and hybrid working, schooling means that there's lower demand for paper-based products, physical office supplies, you know, school supplies, all that sort of thing. So definitely headwinds in this business. Adverse economic conditions have negatively impacted demand in some geographies, particularly Latin America. Demand has weakened. Price pressures, competitive intensity, intense competition both from branded office product makers and private label players. There's very low barriers to entry for many of their products. During weak demand periods, consumers have much more likely to switch to lower cost private label alternatives. So, you know, not great. Foreign exchange headwinds, net sales being materially impacted by currency translations, tariff trade impacts. Yeah, not good. Negative tangible book as well. I don't like that. We can see here. Let's drag this down here and I'll just continue reading off of it. But yeah, negative tangible book I do not like. there is 575 million of debt due in 2029, and currently there is not enough cash on the books to deal with that. And there's not enough current free cash flow being made to deal with that as well. 60 million is significantly declined from historic levels. But yeah, it's not looking good from that point of view. They're almost certainly going to have to refinance the debt if they can refinance the debt. The thing that I will point out though, when we're talking about that, is that if you go on their traded securities, they're reasonably close to par value. One of them is obviously over par value, but that's actually already matured 2024. But the two 2029s around about 90. So there's some confidence in the debt markets that they're going to be able to cover it. The way the business is at the moment, though, there's zero chance of that without refinancing. Income statement, there's been a 25% decline in revenues since 2019, 1.9 billion down to 1.54 billion. There's basically no sign of that decline being arrested either, not currently, so that's going to make debt harder to deal with. Obviously, you've got decline in revenues, decline in simple free cash flow, and at the time of my writing, they were still paying a dividend. Now, I understand that some companies would will still pay a dividend in order to try and keep people invested in them, but I think it's stupid and detrimental to a company to be paying a dividend when you've got the debt maturities coming up that they've got, the revenues are declining, the competition they've got as well. Me, I don't think it's a wise decision. I know a lot of people moan when companies cut dividends or when companies drop dividends, but for me, if it's in the best interest of the company to do so, I've never been bothered at all. I actually quite like it that they're strong enough to make decisions like that, whereas ACCO apparently currently isn't strong enough. Not great from that point of view. I didn't even really go much further than that because it's just all bad signs, but gross margin is stable despite revenue declines. SG&A margin is up, but not a lot. So, if, you had decline in revenues in line with decline in gross margin and all that, it would be a problem, a huge problem. There's not a lot here that I do like. Like I said, balance sheet, we've got some cash and some receivables, a lot of inventory. Now inventory's held at cost, but the type of inventory that they got, how much is it going to be worth in a fire sale? Very little, I would imagine, especially when you've got cheaper alternatives and all that out there, so I don't like that. 525 million in property, plant and equipment. 837 million in long-term debt. They don't really have the ability to cover it there at all, do they? Goodwill as well, 400 million, for almost 500 million in goodwill. Don't like that. Identifiable intangibles. You've got total assets of 2.2 billion and 1.1 billion of that is goodwill and intangibles. So yeah, it's reasonably bleak from that point of view for me. There's nothing there. There's no, it's a distressed industry, so you should be looking at like liquidation values and all that, and there is none really. There's no downside protection from liquidation value, not from where I'm sitting anyway. Tough, but it is what it is. So I didn't really go into the cash flow statement. I just went straight down to this. I said I haven't done proper net present value, so like future forecasting. Historically, they've traded at around 9 times EV to free cash flow. Normalized average earnings around 117 a share, so 9 times would be around $9 a share. But to be conservative, you could drop that to 7. Now, obviously, that would be way above the price where we are now. So obviously, that sounds pretty good, doesn't it? But bear in mind that is normalized earnings. Yeah, current interest expense is around 47 million annually. Normalized free cash flow is around about 120, so it would be covered, but it's very tight. And currently only has 59.6 million free cash flow, so it's barely covered currently. So TTM, we can see it down here at 59.6. This is year on year rolling quarters. They're just covering the interest expense. I don't know what covenants and all that they've got in their debt, but that's a problem. If revenues continue to decline, they're very, very close to being into negative territory on the ability to cover interest expense. This is definitely a wait and see stock, because like I said, should they be able to turn a corner, then there's definite upside here when you look at the multiples and the historical normalized earnings. 133, 138, 126, 150. You're going back some time now, mine. But yeah, we're at the lowest we've been on record. I know I've got one missing there. I'm going to have to fix that. But yeah, so, not great. It's something, like I said, that you're going to have to keep an eye on. This is a very difficult business, competing with cheap Chinese alternatives. Revenues have continually dropped since before COVID. Having to compete against these markets, likely a dying business long term, I've wrote. Now, I don't know if that's true. My opinion is that it's probably not worth a long-term investment in it. But I said, if you can buy it for under $1, then it's certainly a buy. Under $2, I'd look into it for further, investigation. We're currently quite a bit above that. With the declines and the pressures, it's very difficult to forecast future normalized earnings. If you do it on historical normalized earnings, then there's definitely upside here. Forecasting the future for a business like this, it seems a little bit bleak, and they've got the debt maturing that currently I can't see any way other than refinancing they're going to be able to pay for. So yeah, short and sweet really, I suppose, on that. On ACCO, keep an eye on it and see what happens. These are not the actual comps, by the way. I've just not deleted them from the previous video. Yeah. ACCO Brands. There we have it. Thank you very much, and I will see you on the next one.